Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
That's a problem. We all know it's a problem because in the U.S. Politically, when we don't have jobs and we continue to see China in our surplus, our deficit building with China, that creates tensions. And we know what's been going on in the background in terms of wanting China to increase their currency rate. They've manipulated their currency for years. It's quite clear. Anybody that argues this at this stage, I think, is really just silly. You look at the general growth of their economy. We look at the relative level of their suppressed interest rates. It's very, very clear they've suppressed their currency for trade reasons. Germany, on the other hand, has not suppressed its currency, but they are a major driver on the surplus side. And it just is, again, the structure of their economy, most of their growth. And they're not as imbalanced, obviously, as China. China's major imbalance between its consumer side and its export side. Germany's, primarily an exporter, but has obviously a much more balanced consumer base. But relative to what's going on in the Eurozone, Germany is really sucking the wealth out of the Eurozone completely. China, to a degree, is doing that all throughout the Asian bloc, sucking the air out of the Asian bloc in terms of generating wealth. Again, not that the rest of the Asian bloc isn't doing okay, but on a relative basis, China continues to be the big dog, as we know. There's also this, what we call the center versus periphery connection, and the center being really the Western sources of capital, the deep financial markets, and the emerging markets periphery. The game going on there, of course, is these, again, are still major exporters, and the center of the Western markets, whether it be it Europe, the U.S., are the major importer nation. But you also have another dynamic going on here, and that fact is that although we continue to hear this idea of decoupling from the U.S. and the growth here being so strong in these areas, which it is, the reality is this growth is so strong because of the fact that the center, the periphery, is still funding the emerging markets, still funding China with massive liquidity. We saw that in the credit crunch very, very clearly. When the center gets in trouble, the periphery suffers. And we say that, and we still get a chuckle out of this idea that there's decoupling now, that these countries are going to do just fine if the U.S. falls back into a double-dip recession. We keep hearing that again and again, and it never seems to happen. And it's not going to happen. You're not going to see real decoupling until China and the emerging markets, primarily the Asian bloc, develop their own capital markets. What I mean by that is really depth of bond markets so they can have their own local funding. Until that happens, you're not going to have this idea of decoupling. And until that happens, you're going to still continue to have this type of imbalance because of the dependence on this side of the fence to the center financing. So that's one of the parts of global rebalancing that's going to take many years to solve. And part of this problem was supposed to take place after the 97-98 Asian financial crisis. The Asian markets were supposed to start developing deeper capital markets and more vibrant consumer markets. Instead, what they did, they just created a massive amount of foreign exchange reserves as buffers. They didn't develop the depth of the capital markets. They didn't develop their consumer markets. So even though they were buffered to a degree from the credit crunch because of their foreign exchange reserves by suppressing their currency, and being very aggressive on the trade front, they were able to come out of this credit crunch a little better than others were, but that money will not last. They need to have the depth there, so that's part of global rebalancing that we don't hear about. And obviously the China problem is huge. Now, if you think about this and what's going on now, we refer to it as really the key linkages where you can see the risk in the world still. Because of this setup has not changed, and in fact probably has gotten worse since the credit crunch. The G20 was formed to try and resolve this global rebalancing problem, but they've done absolutely zip, probably worse than zip, because we've probably lost confidence just watching these these G20 meetings. I think the last one in Seoul made it clear that the communications and the agreement in the world and the major powers has broken down almost completely, which is kind of scary given that this problem is as bad as it ever was. This global rebalancing problem, ever since the credit crunch, excuse me, of 2000, I guess we say March 2008, as kind of the trigger point. That's when Bear Stearns, they came in and saved Bear Stearns, so to speak. It was March 17th was actually the day, if we use that as ground zero. So we've gone 2.5 years now, and we've seen nothing, and it's gotten worse. And the reason that's risky is because we're now to the fact that even though U.S. demand has fallen in the world, we're using monetary policy QE2 to try and replace demand, which is putting all this liquidity out there. We know the QE2 game, and the reason QE2 has become so pervasive in the U.S. is precisely because demand is falling. We don't have global rebalancing, and Bernanke, as the de facto central bank leader of the world, is trying to do everything he can to keep a modicum of growth alive, and that means keeping liquidity out there in the emerging market world because the growth is not in the industrialized world. So that's part of the game he's playing. It creates all types of I'm not sure if the word's externalities, but all types of other problems we know when it creates that much liquidity and we have that suppression of interest rates. But the primary reason he's doing it is because U.S. demand still isn't there. China's exports are predicated on U.S. demand. German exports now are predicated primarily on Chinese demand. China has become the biggest source of German export growth. And that's one of the reasons you're seeing the dichotomy in Europe. Germany's growing and growing and growing, and the other countries are just crashing down around them, and it's because of this linkage with Chinese exports. So the ultimate driver here is still the U.S. consumer, and that's when you look at these linkages and you hear people say that, oh, we have decoupling again. Don't believe it. And there's no way we're decoupled. And the fact is that if Bernanke weren't pumping out all this money into the world, this U.S. demand problem would be more and more severe in terms of its impact on these relationships. The problem comes, and the key risk is how long is the U.S. going to continue to take all these exports? And as we said, the U.S. job market hasn't rebounded. China has a giant target on them. We've been telling them for years they've suppressed their currencies, and they continue, and they don't act. Obviously, I mean, you've all seen it. I don't repeat what's going on there, but it means sooner or later, either the U.S. falls in some type of double dip recession, and we stop taking these Chinese exports from a demand tapering off even more, regardless of what Bernanke does. QE1 didn't do a whole lot, one can say, to drive U.S. demand. The other argument is that QE1 kept us out of a worse deflation or depression than we were in. We'll never really know whether that's true or not. QE2, the question is, all that money we threw into the market the first time around, is all that money thrown into the market the second time around going to be any different? Maybe so. We'll see. The argument can be made, and we've made it in Currency Currents, that the initial round of QE1 was sucked up by the banks because of their credit. Their own balance sheets were so bad, we didn't see any lending. And now with QE2 and the balance sheets of the financial institutions stabilized to a degree, the banks will feel more comfortable taking this excess cash and making loans. That's really what Bernanke is counting on, and hoping that QE2 really does start to trigger finally some money moving from the financial side of the economy into the real side of the economy, given that the first layer of money, as I said, went in to shore up financial institutions, and a lot of it went offshore to drive this growth in emerging markets and China.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.